Hey guys, it's Stu with Lucid Investing here. Friday, September 16th, just wrapped up the trading week. Today was the day that marks quadruple witching. So I'll start off by explaining that real quick. As you see earlier in the week when we posted the other YouTube video, we switched from the U or September contracts to the Z or December contracts, and that's because of the quadruple witching. So the liquidity, uh, the open interest, my apologies, is much higher on the December contracts now than it was on September, and that's why we made that switch. And obviously, the September contracts aren't in circulation anymore; they expired today. So the quadruple witching is a market wide between options contract, futures contracts of all different categories. All expire on the third Friday of the given expiration month. So there were a lot of options contracts that were zero dates today that expired on top of these futures contracts that expire on the third Friday of the given month. So on the third Friday of December, we will have another quadruple witching, and then we will move to the next contract for the futures. So that's why we saw this really crazy hammer today, and I'm about to go through a little bit more on that and why we also saw a bounce. Another thing I'll say that's a little bit more of a tactical concept, not so much around charting. This is more for people who are having a hard time with risk management, fund management, wherever the case may be. See some people in our group and on Twitter. Most traders fall victim to this at some point in their career, greed. And just want to remind you, you're not in this to hit home runs every day. You don't have to trade every day. You shouldn't be trading every day because you're exposing yourself to more risk. You're exposing yourself to the option of being wrong more times than not. You are simply trying to create profit. And however much of a percentage that needs to be for you is completely up to you. But if you're risking 20 or 30 or 40% of your portfolio at every stab you take, and you're having a hard time becoming profitable because you're aiming for 300 or 400%, there's a reason you're going back and forth or even blowing your portfolio. You're being way too greedy. You should have a max drawdown, in my opinion, of 5% of your portfolio at any given time, maybe 10%. If you've got a smaller account and you're trying to take some home runs and you've got a proven high win rate above 75%, and I'll walk through the percentages real quick on that. To have a 75% win rate, you are able, or I'm sorry, to be profitable on anything less than a 1-to-1 ratio. So if you're going to risk $10 to make $10, you have to have a 50% win rate. Anything less than that immediately becomes 75%. So the second that you start taking trades where you know you're going to take profit before if you're an options trader and you bought a contract for, again, we'll use the $10 example. If you bought that option contract for $10 and that was the max risk you could assume, and you were going to take profit at $5, you have to win more times than not. And that immediately, you can't win every time. Some people can produce 80%, 90% win rates. This concept that we've been applying, which belongs to ICT, the win rate's pretty high once you know what you're doing. But if you're taking low risk to reward setups and you're risking a lot of money, that's why you're not doing well. I see a lot of people in our group always saying, man, I should have made 400, I should have made 500%. That's great if you can do that. But should you be doing that with your full position size or anything more than 5% of your portfolio? Absolutely not. That's poor risk management. And in my opinion, it's gambling. And that's coming from somebody who can repeat profits on a weekly, daily basis. You're supposed to pay the trader. You're supposed to be profitable doing this. It's not supposed to be for fun or a hobby. You might have a better chance of sports gambling if that's what you're after. But I just wanted to kind of get that off my chest. I've been seeing a lot of just unrealistic expectations And the expectation is not to make multiple hundreds of percent. If you do, that's great. And your trade should be framed to where you're supposed to make 3 to 1, 4 to 1, 5 to 1. Because when you start getting to 2 to 1 risk to reward, you only have to be right 33% of the time. Meaning, if you took 3 trades, only one of them has to be correct and you will be profitable. Now, if you're from 3 to 1, now it's only 25% of the time. That's right. You can take 1 trade out of 4 that is correct, where you won, assuming that you held out to that 3 to 1, you will be profitable by losing the other 3 trades. So I hope that's helpful. I don't know if anyone else has been struggling with that, but I've seen a lot of, like I said, unrealistic expectations. So going to the chart, I'll get off my soapbox. We'll start with the S&P. So all of these are the same levels that we've had for weeks now. We are approaching this fair value gap on the S&P. We didn't quite make it there before we bounced. I'll explain that when we get over to NQ. But you can see we retraced basically right down to the 707. If you're a Fibonacci trader, you may have taken that bounce right there. You can say that's why it happened. But once we go over to the other index that corresponds with the S&P 500, you'll see a little bit cleaner reasoning behind that. So I'll point out on this before we go anywhere else, we've got a very large fair value gap here. There's a lot of liquidity residing right there. This is more of a liquidity void. And what that means is if you go into something like a 1-hour chart, and we reference that area again, we've got 1 fair value gap, 2 fair value gap, 3 fair value gap. Point is there's a lot of fair value gaps stacked up on each other. So price ran and never came back to rebalance that price for that area. So it's very likely that we will come to rebalance this before we continue to seek lower lows. Get back to a daily chart. Let's go over to NQ. All right, we have to go into a weekly time frame to explain this one. I tried my best to not make this too congested. You guys know that follow me. I like a clean chart. I don't like really anything on it. This is about as dirty as it gets. Obviously, when you're in lower time frames, it's not as stacked up on top of each other. But if we expand this a little bit more, I'll give you guys a second to try to identify where it is that we bounced right here. Right here, weekly order block. The low of this candle was, I'm going to use the last 2 digits here, 78. The open of this candle was 800 even. So on NQ, that's a very, very tight range. Although it's 13, 12 handles, give or take. I'm sorry, 22 handles, give or take. That's not much when you're on NQ. That is equivalent to something like 6 or 8 handles on ES. So we bounced right off this zone. We also had quadruple witching today, like I explained. So everybody that had been in their contracts created a ton of liquidity today, and the algorithm took full advantage of that. So towards the end of the day, if we go into smaller time frames, we can see how they were able to take advantage of that. Came down here, touched the order block, out of nowhere, boom, 10 o'clock had a huge pump. All right, came back down right after lunch and rocketed right off of it. Prime example of how you can use and should use longer time frames to scale and set up the trades that you're going to be taking on shorter time frames. This right here, being conservative, I mean, maybe you would enter it at the absolute bottom, probably not. That's 150 handle play. That's a substantial payout if you were a part of that. You would have been able to enter that off of a 1, 2, 3, or 4, or 5 minute, right? So that is why we bounced today. I do believe, going back to a daily here, I do believe that we will likely head for this fair value gap at this point. Now, when futures open on Sunday, it's going to be pretty sideways unless there's I know there's an anticipation of the basis point hike. I know 100 is kind of the expectation. I do believe it could be higher. If that does drop, which is unlikely, it drops on Sunday. But if a large catalyst comes on Sunday, we could see price move lower. But as of right now, we hit our weekly order block. And then you can also see here on the daily, this was an old gap. Remember, gaps on futures are pretty unlikely. You don't see them very often. And as a matter of fact, if I go back to our shorter time frames, I know I'm all over the place here. Probably could have planned this out a little bit better. I don't know that we had one on when we go to ES, because I know we had one this morning. We did gap down oh so slightly, and in our Discord, I told everybody to mark this level on their charts. Where did we draw to off that order block? Rebalance that price. Now, I know there wasn't an order block on ES. Right? If I go to a weekly, this is why it's important to look at all indexes, guys. These follow each other. We did, you could say that was an order block. It's not nearly as clean as NQ. NQ is a very obvious order block. Maybe you could say this was the order block before we spiked. That could be fair. Came into it, but we went deep into it. What's important is that we stayed above the 50% of that order block. We bounced essentially right before we got to the 50%. Either way, MNQ was a much cleaner representation of why we bounced, why we did not come into our daily fair value gap, and why we ultimately rebalanced or sought to rebalance this gap right here on the 15-minute. And when futures start picking up volume here in the next 30 minutes or so, we will see this rebalance. And we will look for, close things out, price to come back to our liquidity void up here. So it's likely we could see 4,000 range again. It's also likely we rebalance the price in this gap right here and we come back down. There's no telling what's going to happen over the weekend. I know we've got FMOC next week. So that's going to be a huge economic calendar event, something to mark on your calendars. I believe it's the 20th or the 21st. But you can look that up on your economic calendar. And for those that don't know, we do offer a free week trial in Lucid if you're not a part of that yet. And we provide these alerts and real-time analysis on a hour-by-hour basis. So that's all I got for today and this week, guys. And we'll look forward to seeing you next week.